Snap. Hello, good afternoon. What's going on? We're going to do a little mini lesson now. We're going to be talking about cash, money, and investing. It's probably going to be a pretty good one. So if you're working right now, you can't listen to this. You might want to come back to this story tonight. Today, I want to share a little bit about my personal investment philosophy. I have the word investor in my IG bio here. So I get a lot of messages saying, do you want to invest in my new startup and my new business and all this kind of jazz? That's not really the kind of investor I am. So I thought I would share that. I'm also trying to hydrate. I had too many wines last night. Golly gosh. Okay, if you're an Infinite Prosperity student, if you've been following me for a little bit, this is going to be very elementary. You fuckers already know way more than this. First things first, I use a software here called TradingView. I highly recommend you get TradingView. If you are interested in building your wealth and you want to become an investor, for goodness sake, get yourself TradingView. It costs very little. Here we go, $9.95 a month US. And they have a free trial that you could check out first. But for that price, goodness me. By the time I was about 15, 16 through to probably 24, 25, I subscribed to eSignal, which was at the time the best in the game. But it was like 200 US a month for that. So this basically does the same. Now, when you get your software, you can load into it pretty much any financial instrument on Earth. You can get all the global indices. You can get pretty much any stock that is listed worldwide. You can get Forex. You can get cryptocurrencies. You name it, you get a chart on it. For the sake of this lesson, I'm going to be focused on the S&P 500. The code is SPX 500, and this is a list of the top 500 companies in the USA. This particular index is where the majority of my passive investments are held. To my fellow Australians who always seem to ask me, why do I invest in the US market more so than the Australian market? Well, you're kind of comparing Apple and Amazon to Woolworths and Telstra. It's apples and oranges. I consider myself a citizen of the universe. I'm not national pridey. So if your mindset is to invest locally because that's what you know and that's what you feel comfortable with, and you want to invest in the mom and dad businesses, the small ones, relatively speaking, that's fine. That's a cool journey. I'm going to go where the money is. I'm going to go where the money is, and I'm going to make more, and I'm going to bring more money into the country anyway. So we've talked charting, which is TradingView. Go and get a copy of it, $9.95 a month. We've talked indices, S&P 500 on the US stock market. It's the bigger market. Now I want to talk about one more thing called time diversification. This is the one that gets people's goats. They can't quite fathom this. Now, this is really obvious, but this is the price chart of the S&P 500, and it looks like this, where here's your price and here's your time. Let's just say you purchase at this point in time and price $100 worth of S&P 500 units. This is your entry point. Now, let's just say that this here represents 1 month. So 1 month after you buy, the price has come down. Let's just say you buy again. How many? $100 worth of S&P 500 units. So let's just say you bought here, $100 worth. You bought here, $100 worth. What that means is you are holding $200 worth of S&P 500 units at an average purchase price of this. Your average purchase price is exactly halfway between the two entry points. Now, let's just say another month elapses and price has come down again. It's come down by the same amount as it did last time. And what do? You buy another $100 worth of S&P 500 units. This time, you've got $300 worth of S&P 500 units with an average purchase price of right here. So, if you can keep your shit together, inevitably the market will recover from every pullback. It recovers. Human civilization and business ingenuity is moving forward. That's not slowing down. When you go and invest in something like the S&P 500, you got to understand that the people managing and filtering those 500 companies are some of the brightest financial minds on earth. If the companies don't perform, by the way, they get booted out of the S&P 500 and the new ones come in. The most profitable companies on earth are being filtered into this list by people who are way smarter than us. What we got to do as passive investors is keep our shit together and keep buying in regular monthly installments. Remember what Benjamin Graham said, buy your stocks like groceries, not like perfume. Now, a lot of people struggle with this philosophy because they have very short time horizons. They watch the news and they're very fearful and they think that the world's coming to a fucking end or something, and they think that that Armageddon's on the way. You want to look up the history of doomsday prophecies, by the way. They've been happening since the beginning of time. That's why I said this only works if you can keep your shit together, and the vast majority of people can't keep their shit together. But the objective reality is that we are moving forward. The human race is doing A-OK. Just last night, Elon Musk said the BFR is ready for launch as early as 2019. If you don't know what the BFR is, you want to go YouTube that. The BFR is a big fucking rocket from SpaceX. That's the spaceship that's going to take us to Mars. It is happening in the very, very, very near future. And just last night, Elon Musk said that we're going to need some pizza parlors on Mars. Entrepreneurship and business ingenuity is not going anywhere. It is not going anywhere. It's expanding in time and in space. So by investing in the S&P 500 as a passive defensive investor, you can buy into these profits. And if you're buying the entire market in regular monthly installments of equal amounts, you are exploiting what we call time diversification, and you will approximate the mean growth of that market over a period of time without having to pick the bottoms and guess the timing. Now, what is that mean growth over a long period of time? Bloody good question. CNN Money, here we go. This is a S&P 500 stock index fund. It says performance since inception 11% per year. And VFinks has an inception date of 1976. So that is 11% per annum since 1976. Let's take a look at another one. VOO is another one. This is an ETF. This is available through any broker. What do we got here? 15. The VOO ETF has a really solid, buddy. 15% per annum since inception. That is really phenomenal. However, the inception date for that guy is 2010. So that's not quite going to be the long-term average. But as a very generic round number average over a long period of time, 10%. You buy the stock market, you buy the top 500 companies that are being filtered, by the way, every quarter, you're going to get around about 10%. If you use this strategy, you can approximate the mean without having to pick the bottoms. Now, one final thing that I want to show you that you can try on the charts, you can do this at home, it's kind of really cool to see. Because when you're buying into a bear market, your average purchase price is coming down every month. So the market, when it starts rallying up again, only has to travel a smaller distance to pull into profit. So load up the S&P 500 chart and come up here. Yours might look a little different. I've got mine a little bit customized, but you want to load up a monthly chart. So each bar, come on, load you month thing. Each bar represents a month. Now you want to do something. Check this out. You want to right click on your chart, come down to insert indicator, type in the letters MA. You will come up with moving average. Click that and put a moving average on the chart. Now, because we are on a monthly chart and we're using a standard moving average, we can come into the settings of the moving average and we can focus on the length. So let's just say we type in, for shits and giggles, 3. I'm going to make it white and fat so that you can see it. Now, can you see that there is a line over the bars? That's a moving average. That's a 3-period moving average, which means that line represents the average price for the last 3 months. I'm going to come in here and change it to 12, and look what happens to the white line. Bing, see that it shifted? What this is now, every single point on that white line represents the average price of the market for the last 12 months. This is significant when you're doing this, because at any point throughout history, including in the present, you can say if you had been doing time diversification for the last 12 months, the white line would represent your average purchase price. So you can see here, even when the market's coming down, so is your average purchase price. Just like what we explained here, when we're buying into a bear market, the average purchase price is coming down. So even after a bear market, look, by the time price crosses the white line, you're in profit again. When the market's going down, we're in a bear market, fantastic, that's a win. And when the market's going up, fantastic, that's a win because your holdings are rising in value. So when you become a passive defensive investor and you use time diversification, you don't give a fuck what the market's doing. Up, down, sideways, it's a win. When you change these numbers, let's put in 50, you'll start to see something impressive with the white line. It drops down. In a market that has a long-term mean that rises, the longer the period of the moving average, or in other words, the longer that you invest for, the more profit. If we make it 100 months, it'll come down again. This white line, remember, is the average purchase price. This is why you will hear people say it's not about timing the market, it's about the time in the market. The longer that you're in the market for doing this, the more that your average purchase price will smooth out and create a straight line mean for the underlying market in question. Also, since you're buying every month, your holdings are growing so that when there's a market rally like this, you can grow significant amounts of wealth. If you just do this and you don't do anything fancy and no trading, no speculating, no timing, you can become a multi-millionaire and become financially independent at a relatively young age if you start soon. But on top of that, there's so many ways to accelerate it. For example, 2 times in my lifetime, 2002 tech crash, 2008 GFC, the market has pulled below the 120 moving average, which is the 10-year mean of the S&P 500. At these points, if you put more capital into buying at these times, you're going to accelerate those returns. That's why I say keep cash for the crash. You want to be liquid, you want to be mobile, you want to be nimble, you want to be unencumbered by debt. You want to keep cash for the crash. When the shit hits the fan, when there's blood on the streets, you buy in, and those 10% returns start creeping in over a long-term average to 12, 13, 14. Then you learn to trade and speculate on top of your investment portfolio with a small amount of your liquidity, and you can really ramp up your results based on your performance. You can take some from your investments and put it into your trading speculation and then balance out the pyramid so that you don't fall over and that you grow wealth quite rapidly. At that point, you're done. You don't have to be a slave for your money, go to work every day, because your money's going to work for you. Your money's making money for you so that you can play Scrabble and deal with flooding in the basement, which is what I'm going to go and attend to right now. There's some flooding on my car. Uh-oh. Robin and I came down this morning and we discovered that there was some leaking, but luckily it hasn't hit Lucy. It stopped right here. The building managers here are really cool, and during my media lesson just then they called me and said, maybe we should meet down in the basement, make sure that the flooding hasn't affected the cars. There was an awful accident on level 1. The fire hydrant exploded and there was, oh my God. But in summary, if my investment lesson was enlightening to you, if you learned some things that you maybe weren't aware of earlier and you want to learn more about it, go and get the free membership at Infinite Prosperity. This is what we teach. Everything that I just explained is what we teach in Infinite Prosperity to grow wealth.